Gold holds a unique position in the market, operating as a long-term safe haven for investors. But on a day-to-day basis, it produces erratic, explosive price swings that can wipe out an unprepared trader. During the London Session Breakout, it's entirely normal to see XAUUSD move $20 or more in a matter of hours. Capturing those moves requires holding a standard lot through intense fluctuations. For a typical retail trader, the margin requirement alone is a massive hurdle. Trading a $5,000 personal account, a $30 move against your position translates to a $3,000 loss, a 60% drawdown. Execute that same trade on a $100,000 prop account, and that identical loss is a manageable 3% drawdown, giving your strategy breathing room. By utilizing a firm's capital, the barrier to trading gold shifts. Your primary obstacle is no longer a lack of funds, but your ability to adhere to strict mathematical risk management. The industry pitches a very specific transaction. Pay a small evaluation fee of a few $100s and gain access to six-figure funding. Yet the internal data from these firms reveals that the vast majority of traders who attempt these evaluations fail them entirely. You are trading away your personal financial risk. In exchange, you are agreeing to navigate a gauntlet of strict, often hidden operational rules designed to protect the firm's capital. This matrix plots the marketing promises of these firms against the actual trade-offs required when trading volatile gold. Firms prominently advertise 1-to-100 leverage, but that leverage masks the danger of highly restrictive daily drawdown limits, which trigger automatic failures during normal gold spikes. Passing an evaluation means stopping your focus on the hypothetical account size and ruthlessly auditing the firm's fine print. This chart visualizes the trailing drawdown. The limit aggressively follows your highest unrealized equity point. If gold makes a pullback while in profit, your equity collides with the new limit, failing the account. A static drawdown, anchored to your starting balance, eliminates this hazard. The second major hurdle is the spread tax. The baseline cost of placing a trade can instantly dismantle a high-frequency strategy. For XAUUSD, your firm's spread must consistently remain below 25 to 30 cents. If you're paying anything higher, your short-term scalps are mathematically forced to capture significantly larger, riskier price moves simply to hit a break-even point. Trailing drawdowns and high spread taxes mathematically construct an environment where volatile assets will trigger a failure. They override even highly accurate predictive trading skills. Gold's pricing is tightly linked to macroeconomic data drops. Releases like non-farm payrolls or CPI inflation numbers dictate immediate market direction. Policy announcements and statements from central banks trigger instant, chaotic spikes across the gold market. This chart shows the reality of trading spikes: slippage. It is the costly gap between your expected entry and actual execution fill price. Severe slippage is a direct infrastructure failure, happening when weak liquidity providers cannot handle institutional order volume during news events. These mechanical traps often trigger the worst psychological reaction: the hero trade. This is when a trader weaponizes the firm's leverage, placing one massive bet in an attempt to pass the evaluation immediately. That usually leads to a whipsaw loss, which immediately sparks a cycle of revenge trading, re-entering the market blindly to win back the deficit. Evaluations are rarely failed because of a broken strategy. They are lost due to a collapse in emotional control, which is heavily amplified by a platform's poor execution infrastructure. We are plotting capital availability against a tolerance for strict operational rules. The red zone belongs to the undisciplined trader who fights against heavy momentum. The green zone represents the ideal candidate, the undercapitalized optimizer executing a mechanical, emotionless system. The defining operational skill of a green zone trader is the use of dynamic position sizing. Instead of using static lot sizes, they calculate exact volume based on the specific distance to their stop loss. This ensures their actual dollar risk remains locked at exactly 0.5% per trade, no matter how volatile gold becomes that day. Securing a funded account is an application for an institutional job. It demands institutional-grade risk protocols, not a lottery ticket mindset. Your immediate next step is to shortlist 3 to 5 firms. From there, heavily scrutinize the specific broker and liquidity partnerships backing those accounts. Look for platforms with an explicit track record of processing high-volatility assets without their servers freezing and without restricting your ability to trade during major news events. Run your specific gold strategy on a demo account before you purchase an evaluation. Pressure test exactly how that firm's real-world spread and slippage affects your edge. FXNX provides the exact infrastructure required. With 0.0 pip spreads and Tier 1 execution, it removes the mechanical friction of trading gold. Protect your evaluation fee, choose a transparent platform explicitly built to handle the demands of the market, and turn the wild swings of XAUUSD from a critical liability into your greatest trading edge.